Well, good afternoon, everyone. Welcome to part one of the Sellability of Your Business webinar. This is a part of our exit strategy series that Sunbelt Business Advisor is offering to our clients. These webcast presentations are here to inform business owners so that when the timing is right for you to move on to your next venture or retirement, you're going to be well positioned to maximize what you're walking away with. I'm Joan Young, the president of Sunbelt Business Brokers, which, as a quick plug, we are the largest business brokerage firm in the world, and we're located in San Jose. Today, I'm very pleased to be able to introduce our guest speaker, Dale Radcliffe of the Alternative Board. He's an experienced business executive who has a successful track record of over 30 years in both large companies and entrepreneurial middle market companies. Dale's experiences from finance, strategic planning, marketing, and sales across a variety of industries, including banking, high-tech, retail services, and consulting. So after Dale's 15 years career at B of A, where he held numerous management positions, he became the CFO of 3 consecutive $20 million companies. And during this time, he managed the acquisition and merger of several companies, as well as the ultimate sale of his company to a Fortune 500 company. Pretty impressive, Dale. Presently, Dale is a certified facilitator with the Alternative Board, which is a peer advisory company in the Bay Area. By the way, at the end of our seminar, we're going to have 10 minutes for question and answers, and you can enter your questions in the chat box on the bottom left-hand corner of your screen. We're also going to be unmuting the conference from time to time, asking for responses, so that means no goofing off, guys. So if we don't get to your questions during the time, please feel free to call Dale or myself directly, and our information will be on the last slide for your reference. So Dale, I'm going to turn it over to you to get started on the sellability of your business.
Well, thank you, John. Welcome to the first installment of a 2-installment series on sellability. Presumably, you're online with us today because you're interested in perhaps what the value of your business might be, or sooner or later perhaps selling your business. So what we're going to do is, over the course of these 2 sessions, give you a sense of how you may be able to increase that value of your business so that in the eyes of a third-party acquirer, you can maximize that value, and obviously what we're all trying to do is monetize our long efforts of building our businesses. So with that, why don't we go ahead and move to the next slide, Joan. So very briefly, if you got a piece of paper there, I'd like you to write a couple of things down. I won't refer to this again, but as we go through this workshop seminar, I'd like you to, when we're finished, take a look at it and see what you think about what you wrote down at the end of our session. First of all, note whether or not you think your company is actually sellable today. Yes, no, don't know. Secondly, what do you think your company is worth today? If you've got any sense of that, either through, have you had a valuation done, have you gone to another seminar, gut feel, whatever it is, just write that number down. And then finally, what does your company need to be worth? In other words, if there is going to be a financial payoff at the end of the day, what does it need to be to support you in whatever the next phase of your life is, whether it's going to be another project or retirement or whatever. So write those 3 things down, and then note them later as we finish up the session today, and indeed keep it for next week as well, or next month rather, when we do the second installment, and it'll be, I think, interesting for you to look back at that. Okay, so you're seeing a blank page in front of you, and the reason that it is that I just had you thinking about your company, but for the moment, I'd like you to divorce yourself from your company and put yourself in a position of another company that I'm going to sort of read a little bit of a narrative about. I want you to put yourself in that position, and we're going to go through what might take place if you were to try to sell your company. So let's assume that you, your sister and cousin formed a business about 20 years ago, and after too few vacations and too little time for your respective families, you all agree that it's now time to reap the fruits of your collective labor. Travel, spend time with the grandkids, pursue hobbies, whatever it is. Just take it easy. And the three of you, you've been to a couple of these seminars and here and there over the last few years, and you've learned a little bit about how companies are valued. After discussing the possibility of selling and kicking around what the company might be worth, the three of you settle collectively on what you think is a reasonable amount or value of your company. You would sell it for $15 million. And again, it doesn't matter whether this is the right size compared to your company, divide it by 10 if you like. But in this particular case, let's assume you think it's worth $15 million. And personally, you in particular thought that was a little aggressive, but in the end, you were outvoted. And what the heck, a $15 million number divided by 3 comes out to a comfortable $5 million each. So now we're going to look at some slides that go back last year. So let's take ourselves back to last year. So in the May of 2012, you retained Joan to find a potential buyer, and within a few weeks, teaser packages had been sent to a number of potential suitors. After a month or so, Joan said that there were a couple of potentially interested parties, and on July 15th, you received an LOI that they would be willing to pay $13.25 million for your business. And after another week or two, there had been no other interest shown at this particular time, so you and your partners begin to take more seriously this LOI at $13.25 million. It's clearly below what you and your partners thought the company was worth. But Joan felt that the offer was reasonable given market conditions and the valuation range that she had calculated. After several days of debate, you decided that something like, $4.4 million, if you divide this by 3, a piece, wasn't so bad after all, and you agreed to enter into a lockup period with a prospective buyer and proceeded to enter what was supposed to be a 45-day due diligence process. Well, the 45-day due diligence process turned into nearly a 100-day due diligence process where the number of questions and document requests were relentless. This made it very difficult for you and your partners to focus on your business given this continuing stream of distractions. So anyway, after finally completing this due diligence process, a couple of weeks ago, your advisors, or at least let's go back in time, late last year, your advisor called yesterday with an offer. So go ahead and advance the slide. So one more, Joan. So what was the offer? Wow. It's only $12 million. The LOI was talking about $13.25 million. And furthermore, next slide, please. There were apparently all sorts of other strings attached. And bear with me, and let's read this together. So in their offer, they said, based on the information provided to date, the total consideration that we're prepared to pay for the company is approximately $12 million. Total valuation, or approximately 6.3 times adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization. If any of you wanted to talk a little bit more about that, type in a question. That's typically how companies are valued. It's a cash flow substitute or proxy. So they're coming up with an adjusted EBITDA of $1.9 million when you sent them in your due diligence adjusted EBITDA of $2.1 million. Hello?
Keep going, Dale.
Okay, thought I heard a question. So already they've taken the $2.1 million cash flow that you had shown them for the recent past, and they've cut it down to $1.9 million. Well, that's not the worst of it. They have a structure proposed here that takes this even further down in terms of cash valuation. Let's look at number 1. $8 million cash valuation, and then down below where it says number 2, a $4 million earnout. Wow, what's this? Well, going back up to the $8 million, not only is the $8 million not going to come immediately, but they're only talking about $6 million in cash up front upon closing. Mm-hmm. Then another $1 million in cash at the end of the year. Again, it's secured by assets and so forth. That's not the important thing right now. But then you have to wait another year till the end of 2013 to get the next $1 million in cash. And then comes the earnout piece where you have to meet benchmarks and things can't decline and increases have to this thing has got more strings attached. And at the end of the day, what do we have in cold hard cash? $6 million. So next slide, please. So what happened here? And if you would unmute at this point, Joan, I'd like to hear from the group in terms of what their...
The conference has been unmuted.
What is your reaction, anyone, and I'll call on you if I don't hear from somebody here, what is your reaction to that sequence, that little story I just told, and what occurred? What happened?
Speak up, guys. I warned you that he'd be asking you questions.
Barry, are you out there?
Should be.
Anyone?
I guess they're shy. Go ahead and maybe you can just tell us.
Well, so here we had, we started at $15 million was our sort of admittedly aggressive expectation. By the time the LOI came, 13.25. By the time the offer came, a $12 million package that at the end of reading the document was really only $6 million in cash today, and every other payment beyond that either was tied to, well, was both tied to some benchmark or performance criteria, and even worse than that, even if you met those performance criteria, those payments were out into the future. And so in today's terms, they're worth far less. So this was, and by the way, and Joan can tell you this, she's in this business all day long. Joan, a common kind of a situation?
It really is. Yeah, this is what buyers, they don't want to pay more than, they're afraid there's going to be some changes with ownership, and so they're just hedging their bets and asking for an earn-out with benchmarks. Mm-hmm.
So the lesson here is, what can you do to inoculate yourself as much as possible against these kinds of haircuts, I guess we'll call them, to the nominal price, or at least build the value of your company so when this process takes place, and it's a negotiation. This isn't the end of the line; it's the beginning of a process. But so that you end up at the end of the day with a larger number, and that you end up at the end of the day with a larger number up front in cash, rather than having to meet benchmarks or earnouts or whatever. Next slide, please. So anyway, what we want to do with this couple of webinars that we're going to work with you on over the next month or so is we want to help you build value, whether it's for you, a successor, or a prospective buyer, to put more cash in your pocket. Whether you want to sell your company today, a year from now, or 5 years from now, what we're going to help you do is identify those things that you could improve, that you could accelerate perhaps, that are going to give you a better valuation, a better perception in the eyes of a potential acquirer. Next slide. So, is your company an attractive asset? What would an outside objective party think when they look at your company? And we're going to talk about all the aspects of it. Clearly the financial aspects are going to be there, but we're going to talk about some others as well. What do buyers value? Where do you stand on those parameters of what buyers value? And what can you do between now and the time when you ultimately do really want to sell your business, exit, to improve how attractive you are on these various dimensions? So as you can see at the bottom, increased value for the buyer is going to end up with a better price for you. Next slide, please. So we're going to talk about, over the course of these 2 sessions, 8 separate criteria or areas to explore. The first 3 of which we're going to talk about today, the last 5 of which we're going to talk about next month. So today we're going to talk about financial performance, profitability, how that figures into the calculation, the growth in that profitability going forward, and the perception that it creates in terms of building value. And finally, something that's oddly enough called the Switzerland structure. And I should have said earlier, this sellability paradigm is outlined in a book called Built to Sell, and a man by the name of John Warlaw has coined some of these terms. And while they may sound strange, I hadn't heard Switzerland structure before. I think when we get into it, you'll see how it's an important concept and one that we all ought to pay attention to. So in a month, we'll deal with those last 5 characteristics, all of which, again, can help create value for your business. Next slide, please. So let's take a look at this bar graph. And as you can see, some of the things that we were just listing in the previous slide are graphed and correlated to how good of an offer. Getting a premium, meaning a premium offer, meaning one at the high end of the range rather than the mid-range. What kind of things do buyers look for? And this comes from some actual hard data in the marketplace. And then starting at the bottom, if you look at the bottom, profitability growth is I won't say by far, but certainly is the leading correlator. In some respects, if you don't have profitability and profitability growth, the others really don't matter. So it's a starting point, and it's an important one. Growing industry as we work up together on the graph here. Relatively low market share. This may seem counterintuitive, but it turns out that the more share you have in a market, the harder it is to grow. And as we're going to see in a few minutes, the growth aspect of cash flow and profitability plays a huge role in terms of buyer perception and in the actual valuation. Low customer concentration. I'm just working my way up the graph. Recurring revenue. You have to go out and earn new revenue every week, every month. Or is there some sort of a recurrence or a repeatability built into the model? Company size, 5 times factor. We'll talk about that in a little later in this session. But to what extent is there growth room without increasing fixed costs? Again, we mentioned the Switzerland factor. We'll talk about that in a little bit as well. The management team. Are they going to stay? Are they going to leave? Are they good? Are they average? All of these play into the equation, as it were, for a buyer when they're looking to buy your company. Next slide, please. So buyers care about what? Well, they care about profit in the future. And not only is it profitable, but is it growing into the future? Is there some momentum here? And the thing I think that many business owners that I work with don't realize is the buyer is going to be skeptical, and so they're going to be looking at signs for reliability in those estimates. Are they realistic? Can you back them up? And as we'll see in a minute or two as well, the recent past is the best predictor of the future. And so if you're going to make some statements about future cash flow, hopefully you've got some history to back that up and some facts and a compelling story about how those cash flows are going to behave going forward. Next slide, please. So we talked about track record, positive cash flow. Is revenue growing? Is the top line growing? Clearly the bottom line is going to be the ultimate determiner of the value. But and are the financials believable? And historically, by the way, are these terms that CPAs use when they look at your books every year, are they compiled, are they reviewed, are they audited? Audited statements are the most objective and typically most valued by a buyer, but many of the companies that I work with, and Joan perhaps as well, don't have audited statements. And so
right.
is that true, Joan?
Yeah, it's very rare. Just oftentimes for the larger companies, 30 million and above, often a buyer will ask to have that done, but they typically haven't been. Mm-hmm.
So people like Joan and I, when we get involved with clients, will often go through a modifying process. I call it normalizing. This very often, and perhaps those of you on the call here do it yourselves, oftentimes you mix a lot of personal expenses in with your business. And so we go through a process of taking all that personal stuff out so that the P&L and the cash flow, the EBITDA, reflects more the pure company operation. And it was that adjustment, as we saw in the story a few minutes ago, that the buyer apparently, I guess, for lack of a better word, was skeptical about and reduced that EBITDA figure, which therefore ultimately the valuation went down as well. Okay, next slide, please. So let's go into this financial performance, the first of the 3 things we're going to talk about. And we're going to spend the most time in our session today talking about this because it is probably the primary driver of what an acquirer is going to look at. And when we say financial performance, we mean the profitability or cash flow. I'll kind of use those interchangeably, even though they're not technically the same. But I think for purposes of our discussion today, we'll just use those interchangeably. And as we said earlier, it's that recent past and what we expect and what we can convince a buyer is likely to happen in the future. And then the other aspect of it is perceived risk. In other words, by perceived we mean the buyer's perception, not yours. They are going, and we're going to see how they're going to incorporate that risk very explicitly into how they value those cash flows going forward. Risk is not a trivial thing. And so I guess as a sidebar, I would say anything that one can do in a sale process to convince to lower that risk perception in the eyes of the buyer is ultimately going to help your valuation.
Dale, I would say probably one of the biggest risks that my buyers see, that if it's all about Bob, as I call it, if the seller is the one that has all the relationships with the clients, doing everything, that's very risky to a buyer. And so if any of you are in that position, bring on a general manager or someone else that is going to be more the face of the company because that makes you stepping out much less risky for them.
Excellent point. And we're going to talk about that in a little more depth next month because, but yeah, these risks are going to be quantitatively reduced into the valuation formula, and we'll talk about how that happens.
Okay.
So how does this valuation process work? I'm going to introduce you, if you haven't already been exposed to it, a concept called the time value of money. And this concept basically, as we all know, says that $1 today is worth less than $1 tomorrow. That gallon of gasoline or that loaf of bread next year, at least if history holds true, is going to cost us a little more. And so if you were, for example, to go into a bank, and you can see my little graph at the bottom here, and deposit $100, and that bank promises you 5% interest. I know this is a little unrealistic today, but let's assume it is. Offers you 5% interest, then you can pretty much count on the fact that you're going to get $105 at the end of that year, or that the $105 will be in your account. And the reason there's interest is, and that's fairly low interest rate because, again, we're going to talk about risk in a minute, but there's not much risk in putting your money in a bank. Inflation erodes the value of money. That's the basic concept. Now notice that I made that arrow go both directions. So for a minute, rather than looking at today at $100 and tomorrow at $105, let's fast forward to the future. So here we are in don't back with the slide.
Okay.
There we go. The $105. Let's talk in reverse. So listen to how I put this. $105 1 year hence at a 5% discount rate is worth $100 today. $105 in year 1 year hence, is worth $100 today in today's dollars at a 5% discount rate. So I kind of took that interest concept and worked it backwards. I called it a discount rate. I didn't call it an interest rate because interest rate is, being reimbursed for not consuming today and putting it off till tomorrow. I called it a discount rate. Think of it as a mirror image or a reverse interest rate. So this concept that we used with the $100 and the $105 is exactly how valuation specialists take your future cash flows and your risk, and we're going to talk about that in a minute, to establish in today's terms what the value of your business is. Now, Jim, you can go ahead and move it.
Okay.
So let's take a look at just 1 year, and let's say that your company is expected to deliver $100,000, and the buyer believes this, $100,000 in the next year. By the end of next year, you will have earned $100,000. And let's assume, for purposes of this example, that the buyer believes that the discount rate that is appropriate for your company is 15%. I will share with you that if you're a small business, even some medium-sized businesses, they will probably affix a much higher discount rate, maybe as high as 25, 30, 35%. But let's use 15 for the moment. Let's assume that's the risk that they see in your business builds the discount rate up to 15%. So at a 15% discount rate, if you look at the far right of the little graphic, little chart here, that $100,000 discounted back to the present is only worth slightly less than $87,000. So it may have occurred to you already that the higher the discount rate, the lower that number on the right-hand side is going to be, and we're going to see an example of that in a moment. Okay, so let's take that out another year. So let's go to the next slide, please, Joan. Here we are in year 2. Once again, we expect to earn $100,000 in year 2. And because it's 2 years out, we have to discount it back twice, okay? And that $100,000 2 years out is only worth a little under $76,000. So you can see that number is getting smaller and smaller. And if we project out a full 10 years of level profit, $100,000 every pre-tax profit every year, you can see that as we go down the right-hand column, it gets worth less and less in today's terms, again, because of that discount rate. We end up with just a little over $500,000, which is what? Just better than half of the nominal $1 million that we earned if we had $100,000 times 10 years. So you can see that this discounting process really does allow a buyer to compare different investments, different opportunities, and put them in today's terms, both accounting for the time value of money and for the risk, and for whatever projected cash flows there are. Joan, I'm going to go ahead and just take a moment if anyone has a question. I remember the first time I was ever exposed to this concept. It was a little strange. I'm so used to it now. I just want to make sure everybody understands what we're talking about at this point. Are there any questions at all, or shall I go ahead and go on?
I want to make sure that if somebody does ask a question that they unmute their phone, because I think a lot of them have muted it on their end, and I've unmuted it, so you just have to do your own, and then feel free to ask any question.
And it's good. I haven't heard any background noise, so people are being nice and quiet back. Okay.
Yeah.
Any questions at all about this concept? Okay.
Okay.
Well, let's go ahead and move on.
Okay.
So remember we talked about risk, and if you look at the far right column, this is what those same numbers look like, that same cash flow scenario, if you increase the discount rate to 50%. And you may go, my goodness, 50%, that's enormous. But as I said a minute ago, your business in the million to $5, maybe even $10 million or more, and again, depending on the industry and your situation, the discount rate that a buyer is going to apply is likely to get at least a 25% and perhaps as high as 35, or depending on the situation, maybe more. But if you look at the right-hand column, that 50% discount rate and really takes the present value of that of this hypothetical company series of cash flows way, way down. Lower right-hand corner, $196,000. Compare that to the $500,000 we saw at the 15% discount rate, and you can start to get the idea how important risk and your ability to communicate a lower perception of risk is important in terms of doing a deal. Mm. Now, you may think, wow, that's kind of a high number. I'll tell you this, Cisco, if you were to go to Cisco's annual report, big company, we all know it, they buy a lot of companies. I can remember one year in particular, about 3 years ago, they actually disclosed in their annual report, in their financial statements, the discount rate that they used for a couple of acquisitions. One of them was 35 and one of them was 38%. And these acquisitions were way bigger than $10 or $20 million companies. But the risk there was the technological obsolescence. That's pretty fast
changing,
as we all know. Exactly.
Yeah.
Definitely strategic, but that's a space where technology is moving quickly, and if you can't exploit that technology quickly, the acquisition could have been worth nothing. And so it really forces the cash flows to look real good in order to justify the investment. So that's the fundamental. The fundamentals of how cash flow is calculated into valuation. The second concept of the three that we're going to talk about today is profitability growth. And so just a minute ago, as you recall, we just showed a level $100,000 cash flow, EBITDA, if you will, per year. And we're going to talk about why growth is important now. Well, I can think of at least three reasons. First, and the obvious one, is you're going to see momentarily the financial value implications of a growing cash flow or profitability going forward. That perception, there's something about the momentum and the growth of a company that changes, at least in my experience, the psychology of the acquisition. Imagine if you were buying a company and you were seeing a company that had either flat or even worse declining cash flow, the tone of that whole negotiation, that whole perception is going to be different. Whereas if you've got some growth going and that buyer can visualize themselves taking advantage of it and grabbing onto that growth themselves, you got a much better negotiating dynamic, I guess is what I would call it, going forward as a seller. Joan, would you agree with that?
Yes, absolutely.
Yep. So let's go to the next slide. We're going to do a little bit of a sidebar. If your business, you're in a certain market, you have a certain product or set of products today, let's just take a look at this matrix for a moment in terms of what options you have in terms of growing that revenue and hopefully that bottom line, that profit or cash flow. And we have two dimensions here. The horizontal dimension, left to right, is going from current products to a world in which you're adding products. And the vertical dimension, if you look in the upper left-hand corner, is what are your current markets and to what extent are there opportunities in new markets. And if we sort of stay in the upper left-hand corner of the matrix, when we're increasing our product offerings within our current market, we call that market penetration, getting more market share in our current market with our current products. Going to the right, to the upper right-hand corner, when you add new products, when you can be creative and say, what can we offer our existing market, new products, we call that product development. And then the lower left-hand corner where we're offering current products to new markets, and that could be geographic markets, that could be creative ideas about taking our products and getting new applications in areas, in industries or customer communities that we hadn't thought of before. That's referred to as market development. And if you're doing both, new products into new markets, we call that diversification. And I encourage you to think about, and again, I don't know if they're going to have available to them this slide deck or not, Joan, but certainly make note of this matrix for your future thinking, because it's useful to think of your business in these terms and start to get creative about whether you can increase revenue through adding new products to existing markets, or your current products to new markets, or both. Good ways to think about your business strategically. Okay, next slide, please. So the underlying concept here, if positive cash flow is good, as we saw in the schedule a couple of slides ago, then growing cash flow is even better. So when the valuation experts go in to, and Joan, you no doubt have done this, and I've done it as well, what we do is we weight the most recent past experience as most heavily. And one common, and it's not, this can vary, is that your most recent year is weighted 50%, the year before that 30%, the year before that 20%, because again, the most effective predictor of the future is the recent past. Are those the percentages you use roughly, or what do you use, Joan?
We divide, we put, add the 3 years and then multiply the most current number by 3, the next year by 2, and the last year just by 1.
So it's same concept.
Uh-huh.
Yeah. The most recent is again, the most important.
Yes.
And we talked about this a little more. I've said a couple of times, can you change somebody's perception of risk? That isn't always easy. But you need a compelling story, and it does need to be convincing, and it has to be backed up with reasonable assumptions, because automatically your story is going to be viewed with skepticism. And frankly, it's in their interest to do so, because that is ultimately, if they can change the risk profile or somehow whittle down your cash flow, it's in their interest, because it's going to ultimately lower their offer. Mm-hmm. So it is very important to think through your trajectory, what your plans are, and why that cash flow is going to look good and grow going forward. Mm-hmm. Okay, next slide. So here, now we're going to put growth into our schedule. Remember the schedule we had in the middle column? It had $100,000 all the way down for 10 years. Here's one where we're growing it by 20% a year for 10 years. Now that's pretty aggressive growth for a long period of time, but I'm exaggerating a little here for a point. And let's go back to the more, what's the word I want to use? Not conservative, but
aggressive.
The more attractive to the seller discount rate. What were you going to say, Joan?
I'm sorry, I keep going in and out of mute and not mute.
You were going to make a comment about that discount rate, I think.
More aggressive.
Yeah, it depends on which side of the negotiating table you're on. It's more favorable to the seller. Let's put it that way. Back to the 15%. Notice what happened to the present value of that series of cash flows when we grew them by 20%. It went to a little over $1.25 million in present value terms. And remember, right below that, we had with a $100,000 a year level of cash flow year to year, it was only a little over $500,000. So that 20% growth in expected profit cash flow has yielded more than double the valuation using these discounted cash flow techniques. Brings home the point, growth is huge in the valuation equation, both quantitatively and qualitatively. Mm-hmm. Okay. Next slide. Another couple of concepts that have to do with growth and the ability, the foundation for growth. We're calling this the scalability trifecta. If you can come up with a business model, and whether you have that model today or not, think about your business and what you might be able to adjust or do to attain a couple of these attributes. Teachable, something that's easily teachable, that doesn't take a rocket scientist to know how to deliver. Something that's valuable to the customer, and that goes without saying no matter what business we're in. And something that's repeatable, that can be formula, that can be replicated in terms of a revenue driver going forward. Now remember, we're talking about profitability growth. Generally, you have to get a higher top line. That's got to be growing in order to get a substantially better bottom line. So go ahead and let's go to the next slide. Here we see a young man pumping gas. When I gave this presentation live last November to a bunch of CEOs, I said that was me in 1964. There I was pumping gas. Why are we showing you this slide? We're talking about teachable, repeatable, valuable. Think about the day and when we all went to a gas station, and many of you may be too young to remember that. You used to go to the gas station to get anything fixed. Your car broke, something went wrong with it, you took it to the gas station, the mechanic fixed it. Well, was that a repeatable, teachable model? Well, yeah, if you want to be a certified mechanic, and it required a great deal of labor and time in order to perform. Well, one day a guy by the name of Jim Heineman back in Baltimore was challenged he was a football coach, and his football players said, all the great ideas of the world have been taken. There are none left. What are we to do as young men going out into the world? And Jim said, I'm going to take up that challenge, and I'm going to find a business that has a lot of upside. Well, he went out and he discovered a little chain of quick oil change centers. And Jim Heinemann went on to found the chain of quick oil changes that we all know as Jiffy Lube. So why are we telling this story? Well, that oil change that we used to go to that gas station for, they were able to take a piece of that automotive maintenance out of what John Warlaw likes to call the break fix. My car's broken, fix it. It's the maintenance. It's the relatively simple, teachable process of changing oil, fluid maintenance as the industry calls it. It's clearly valuable because, as we all know, changing your oil frequently is the lowest cost form of insurance against engine wear and breakdown. And it's repeatable. And gosh, there are literally thousands of those quick oil changes around the country now. It was a model that was scalable because it was teachable, it was repeatable, and it was valuable to the customer. And that is a huge, huge business. And I actually spent a fair number of years in that industry building up a master franchise. So a perfect example, I think, of taking something old school that was difficult to replicate, technical, peeling off that piece that was teachable, repeatable, and valuable, and making a huge industry out of it. Next slide, please. Talked about that 5 times factor earlier, and this is another aspect of what we call scalability. Scalability being the ability to expand the business without difficult challenges or hurdles to overcome. And by the 5 times factor, we mean to what extent can you add volume without adding substantial fixed cost? And a perfect example, as you can see on the slide, is a hotel with a relatively low occupancy can add revenue without significant overhead. Sure, they may need more maids and they may need housekeepers and whatever, but they don't have to add new rooms, new building, new fixed costs, which makes the business much more scalable. So it's got much, much more growth potential. And another aspect of scalability is, are there cross-selling opportunities in your business? Can you add on to what you're already selling to your customers, what solutions you're providing? Can you add solutions to the portfolio of things that you're doing? And so that's what we mean by, or at least John Warlaw means by 5 times factor. Okay, next. Next slide, please. Hello?
I just went to the Switzerland structure, which is the next slide.
Perfect. Thank you. I was afraid I'd lost the connection there.
Nope.
Switzerland structure. What the heck is that? Well, I have to give you the background on this because that's, when I talked to John Warlaw about this, this is what we talked about. As you may know, Switzerland has remained a neutral country in the face of all of these wars over the last century. So I don't know how they did it, but they did it. And so this notion in business of the Switzerland structure basically says, don't put all your eggs in one basket. And as you can see on the slide we're looking at, these 3 bullet points, they talk about diversification. And you probably already know this. If you have too much of your business with one customer or 2, the risk of them leaving is huge, hugely detrimental to your business. So having no customer be too large of a percentage of your business, a wide variety of customers, is obviously, it buffers you against the unexpected and unknown departure of a customer in the future. Too little choice of suppliers. Perhaps some of you, maybe all of you, have experienced what it is to be the nail-biting situation of being totally dependent on one supplier, and if they hiccup, you're down. And I know I work with a lot of clients in making sure that we've got multiple choices of suppliers so that we're not overly dependent on any one supplier. And then finally, the reliance on too few key employees. They get hit by a bus and suddenly you're really held hostage. And of course, this is all logical and important for running our businesses on a day-to-day basis. But in the context of selling your business, buyers look for this. They are worried about a concentration of customers or suppliers or too much responsibility and value put into one employee. And as Joan said earlier, if you're that person and you're the one that's exiting the business, it's even worse.
And Dale, I wanted to just add that you had mentioned earlier the term an earnout over years, and it's having performance criteria each year. These are the three categories that will make them want to ask for an earnout in their offer.
Indeed, and by extension, you may not be out on that sipping Mai Tais in Tahiti. You may be still back in the business, making sure that the earnout maximizes the value to you. So,
absolutely,
a lot of implications there.
Okay.
Okay, good. I think we came in roughly on time. Maybe we'll even get these guys out of here a little bit earlier. But with that, Joan and I are ready to answer any questions you may have.
Yeah, so I have you all unmuted. I didn't mute you again, and as long as your phone is unmuted, feel free to ask Dale any questions of the. Remember, we have just covered the first three of the sellability proposition, and next month on the same date, the 27th, we thought we'd make it easy for you. We will be covering the next 5 factors in getting your sellability score up. Dale, I wanted to ask you, would you rather wait until we finish next month before I send them a sellability score test that they can take so we can find out exactly, you can find out exactly where you are from 1 to 100 at this time before you make any changes of how sellable your business is? Would you rather wait, Dale, or would you like me to send that out today?
Well, I could go either way, but it occurs to me that if they were to actually take the assessment, what we're talking about might be much clearer and relevant to them. So if you don't mind, I'd go ahead and send it out to them now.
Great. I will do that today.
And I encourage all of you to take this because we've done it with many, many clients, and it has been that it has triggered. How do I put it? It has triggered the right conversations with our clients about how to fill the gaps in that score so that they, as we said at the beginning, maximize the potential offer that they will ultimately get when they sell their business.
And even if you're considering selling 5 years from now, that's even better because you have more time to fix the things that might be holding the price back on your business. So I will make sure everybody that was on the call today will get that. Any questions before we end? You must have done a good job, Dale.
Well, thank you, and I look forward to joining you again in about a month. Thank you for tuning in, as it were. Again, you said, I think our contact information was going to be on a slide. Is that there so that if anyone wants to email a question, they can?
I'll just do this next one. Thank you.
There we go. Okay.
That's just a reminder of when it is, part 2.
Oh, no, there we go. There we go. So there's our contact information. Call either or both of us if you want to discuss these concepts, have any questions. You're a modest group. We haven't heard from any of you all through the session. So.
I know. You usually get so many questions. But thank you so much, Dale, for your time, and thank you for those of you who joined in. And we will, I wonder if it's because you have disabled chat. No? Okay. Okay, well, so hopefully we will get that out to you today, the sellability score, and hope to see all of you back on the 27th of March at 2 p.m. Thanks again. Have a great day. Bye-bye.
Thank you. Please stand by.